And we have something very special for you next. It is the ever popular TAM panel. If you don't know what TAM is, you're going to learn more about it in the next half an hour than you ever thought that you need to know, but it's one of those metrics that is both art and science, which makes it very hard to nail down. So we have Walter Thompson, we have Jomayra from Reach Capital, we have Helen from Phenomenal Ventures, and we also have Monique from Cake Ventures. Put your hands together. This is going to be great.
Thanks for joining us today. TAM, total addressable market. We're going to have a kind of a jargon-heavy talk today, so we're going to get ready for some acronyms. But we're definitely in a down market. But for founders who are eager to build and scale, venture capital is always scarce. So today we're talking to 3 investors to get their candid advice for founders, especially first-timers, with regard to how to calculate total addressable market, how it differs by sector, and why there's no such thing as a TAM that's too small. Before we get into it, I'm going to ask each panelist to kind of share their investment thesis, because I think it's relevant to today's discussion. We can start at the end with Monique.
Hi, everyone. I'm Monique Woodard. I'm the founding partner at Cake Ventures, an early-stage firm focused on seed and pre-seed investments into companies that accelerate based on demographic changes like aging and longevity, the increased spending power of women, rising majority-minority communities, things like that. Gen Z, thanks for having me.
Hi, I'm Helen. Great to be here. Thanks for coming. We started Phenomenal Ventures last year and closed our debut fund to invest in early-stage companies across enterprise software, fintech, and commerce, which draws on our unique experiences as operators. We've invested in 18 companies so far, including User Clouds, Plenty, and Creative Juice. And we're excited to be here. Thanks.
Hi, everyone. I'm Jomayra Herrera. I'm a partner at Reach Capital. We're an early-stage venture fund focused on investing in education and the future of work. We've been around since 2015 and recently raised our 4th fund. It's a $215 million fund. And we focus on investing both for financial returns and also impact returns as well. And really excited to be here.
I'm glad you're all here. Thanks very much. Like I said, it's going to be a jargon-heavy discussion. So let's quickly define our terms. Total addressable market, serviceable addressable market, and serviceable obtainable market. So I picked a hypothetical example, bear with me. For a startup that sells plant-based dog treats, TAM would be everyone who has an interest in visiting a shop that sells pet food. The SAM for this business is everyone who wants healthy dog treats specifically. And then SOM is essentially how much you think you could sell to those people, go-to-market strategy, essentially. Do I have this more or less correct? Or? Okay, great.
Exactly. Good frame.
So thanks. I studied last night. But basically, TAM gives investors a better understanding of your company's upside potential, and SOM and SAM help offset risk, basically. Let's just dive right in. So taking issue with today's premise, does calculating TAM really change during a downturn? Or is it kind of a static kind of, it's something you just have to do, basically?
Absolutely not. We are certainly in a very different funding and fundraising environment than we were a couple of years ago. But for me as an investor, the TAM calculation doesn't really change whether we are in a more flush environment or a less flush environment. You're still going to be looking for companies who are, addressing large markets and really trying to figure out like the biggest TAM that they could get to.
Okay. Do we all kind of concur? Or?
Yeah, I totally agree. I think the thing to think about is what hasn't changed even with the down market is the size of our funds and the exits that we need to realize in order to return those funds. And so the calculation essentially stays the same.
But going actually left to right, what range of TAM interests you? Like is there a number, kind of a ballpark as far as too big, too small?
Left to right or?
Right. Let's go this way.
I'll jump in. I don't think there's such thing as too large of a TAM. I think investors generally get excited about large TAMs. It has to make sense for venture-like returns, especially the larger the fund size, they're really going to care about TAM. But I think, and all investors will say that they want to see a big TAM. I think most investors would also say they want to see a small initial market, a market that is just your customer base that's just obsessed with your product. I think what makes us a little different at Phenomenal Ventures is we're really interested in how you get from point A to point B. So, I mean, how many companies have we heard of that have a really large TAM but can't really ever break out of their initial customer segment? Then they won't make it, right? So that's something that we help with, drawing on our experiences as marketers and strategists at big companies. And we've seen these companies go from their earliest stages to making it. And so my co-founder and I, we've worked at companies like Facebook and Dropbox and Uber, and so we saw them make it eventually, but sometimes they did it very quickly, sometimes they had a lot of trial and error. So I think really focusing in, so something that stays evergreen regardless of what the market looks like, is just how are you going to get from that initial segment to however large that TAM is.
Is there a TAM that's too small for you then?
Probably. I think if it doesn't make sense for venture capital, so I think one question you could ask is, depending on really looking at the size of the funds that your investors are investing out of, having a 10 or 100x return on their investment in you, if that doesn't return their fund, it probably doesn't make sense for them to invest.
I also think it's fine to express sort of a beachhead market, right? But what we want to see is that you're able to go into a much broader market after that, right? That you're able to get some product market fit on a, maybe smaller, not quite optimized TAM part of the market, and then you're able to kind of expand it to the much broader scale market. I do occasionally see founders come in and talk about, TAM, to your point of TAM, there's never a TAM too big. Sometimes they're like, oh, well, everyone is our market. Well, okay, everyone is not your market. So let's try to refine that and figure out who your market actually is. So sometimes there can be the expression of a TAM that is too big, but yes, we are always looking for a big TAM.
Yeah. The only wrinkle I'll add is most of us, or at least at Reach, the way we think about it is from a portfolio perspective. So in each fund, we'll invest in, let's call it 25 to 27 core companies. And for most of our companies, we're looking for opportunities that have very large TAMs, have very large exit potential. But because we are a sector-specific fund, we are able to see and know when there is a company that has a pretty good exit. It might not be $1 billion exit, but from a risk-adjusted perspective, it's less risky. It might fall closer to the $300 to $500 million category. But because it's less risky and we think about it from like this portfolio, we'll have lots of outliers. And then maybe we'll add in a few of these of like, we're pretty sure these are going to be good outcomes for us. Maybe not return the entire fund, but return a third of the fund or a half of the fund, which is very much needle moving. And so there's a little bit of a wrinkle there in that it's not just sometimes the individual opportunity, we think about it in the context of the entire portfolio.
Given the areas where you invest, do you have a preferred calculation approach when it comes to TAM, like bottom up, top down, value theory?
I was just going to say, it's really like a triangulation of all of it. So you want to do bottoms up, you want to do tops down, you want to do a ton of market research to kind of triangulate like what's the zone in which the TAM is in, as opposed to just relying on one. I would say like between the ones you mentioned, it's like I usually prefer bottoms up over top down because there's a lot of details that are missing in the top down analysis, but really what you want is just triangulation of multiple methods.
There's also, founders making the case that the TAM will grow and their unique role in growing that TAM. So, for example, if you're a company where we made a couple of CPG investments. One of them is in Fishwife, and if you guys have been following like the tin fish craze post-pandemic, they're a company that really they count their TAM as not just everybody who's buying tin fish today, but they're going to play a role in making this really popular and something that's already very popular overseas to the United States. So they're looking at other healthy snack foods, charcuterie boards and things like that will count towards their TAM. And so if you're either a category leader in a growing category, I would say that you actually can explain what your unique role in actually growing that TAM would be.
I really think founders should use the TAM discussion with an investor as an opportunity to show them how you think about it, right? So it's less about do we prefer top up or top down or some hybrid version. It's really allowing the founder to say, here's how I think about the market that we are playing in, and here's what I know about it, and let me show you how we think we can get as much of it as possible, right? And that point about being in a growing market is so important, because a market can look small today, but it's really up to a founder to convince me that that market is growing, right? Maybe, and if the market is big but not growing, that's also a problem, right? So we want to see a market that is not just what it is today and it's going to remain stagnant, but we also want to see, can we extract additional value from that market?
So how much should founders show their work in, I mean, we're talking about basically like a 16-slide max pitch deck. How much work can you present as far as, here's my thinking, the framework I use to derive this number? How much can you actually show in the pitch deck?
I'm starting to see a lot of sort of standalone documents on how they arrived at their TAM that's outside of the pitch deck, because agree, you want to keep that pretty concise, so there can be sort of additional materials. I would say that show your work is actually the point. So, you tell me your TAM is this, like, I'm not going to go fact check that and spend a ton of time on and see if, you got really precise on that calculation. What I am going to spend time on is, like, what are your sources, and, where are you getting the insights to actually calculate that TAM? And so it's similar to, if you guys are raising money and, you arrive at, we're going to raise this much money for this round, I think as investors, you can have an opinion on whether that's too much or too little, but it really doesn't matter at the end of the day if you're really showing where that money is going to go and how you're going to put it to work. It's also similar to like the classic consulting interview exercise of how many ping pong balls can you fit in a 747. It's like they don't really care what the actual answer is. They want to see how you arrived at that number.
Yeah. I think also to the point Monique was making earlier, it's a conversation. It can be voiced over. It's meant to be a back and forth. I may ask questions, dive deeper, dig into your assumptions. And the truth is there is no right or wrong, like here is the exact number. It's more about, do we have overlap and agreement in the assumptions around your drivers?
I mean, going back to the pitch deck question though, the TAM slide, of all the slides in a 10 to 16 slide deck, how important is that one? Is it most important, somewhat important? Is it in the middle? Like, where would you put that as far as?
It's not most important.
Yeah.
The team slide is probably the most important. Yeah. But I think of it all as a jumping off point for a conversation. So I may, before the meeting, I'm going to honestly, it's very quick. I'm going to go flow through the deck very quickly to determine, okay, is this something I should be having a conversation about? I'm not going to spend a ton of time figuring out whether the TAM is too big, the TAM is too small, whatever right now, because this is really, the deck is the door opener to having a broader conversation about the business itself, of which TAM is a really important part, not the only important part, but which TAM is a really important part of.
So actually, you already answered my next question, which is how much of your due diligence is spent checking TAM? It sounds like not that much, but later when you get into the relationship, it's more of a consideration, I suppose. This is something you brought up, that it seems like investors often have a better sense of the TAM than the person pitching them. I've heard this from a few investors because they get pitched on a sector 10 times a day, and the investor is just learning about the sector, and they're trying to get into it. So there's an imbalance there. And so one of the quotes was, it's always going to be too large or too small. It's almost always going to be wrong. So it's more about being directional. Is that a fair assessment? Or?
Well, first I'll push back on the premise of the question, which is sometimes the investor knows TAM better than the founder. So in our case, because we are sector specific and our job is quite literally to go into very deeply into specific subsectors, more often than not, we do know the TAM better than the founder. But I would say for most generalist investors, again, depending on the category, they're learning and trying to get up to speed as you are pitching them. And so I think it just totally depends on who you're talking to and what the sector is and the category. And even then, for us, there are some sectors that maybe we've been investing in for some time, but some new wave happens, some new technology pops up, and we got to actually question all of our assumptions and start to push ourselves in our thinking. And so And so even the premise of the question, it's not always true. It totally depends.
Okay. Actually, which is another thing. With more companies introducing AI into the mix, how is that changing the math as far as TAM, or is it not? Starting with you, Helen.
I have plugged in what is the TAM of this category into ChatGPT a couple times. No, I don't know how much that's, we don't specifically invest in AI in that sector, so, we're not using AI to calculate the market either.
But so founders aren't trying to find some way of kind of shoehorning in an AI angle to increase their.
I don't think so.
I mean, I don't think it's specific to increasing their TAM. I think it's specific to what a lot of investors seem to be interested in at the moment. But I don't really invest in companies that would call themselves an AI company, right? I invest in companies that are solving a problem for a specific set of people, and maybe they're using AI to do that, right? And so then AI doesn't really impact the TAM as much. It impacts the delivery of the technology.
Right. Yeah, for us, just to share a concrete example, we've invested in the category, it's called lesson content delivery, in a company called Nearpod that had a very successful exit. And we actually found the AI equivalent of that company, and we recently just led their seed round. The market itself hasn't really changed. It's still lesson content delivery, but we think because this company is leveraging AI, they have an opportunity to actually become the incumbent in that market. And so I don't think it necessarily changes the TAM. Maybe the TAM has changed, but more so because there's more technology adoption in school districts, and it's less so related specific to AI.
What about new products and services? How would you calculate TAM for something we haven't seen before, like personal jetpacks or flying cars? How do you find a comparable to compare and kind of calculate?
There's always an existing market. There's always a way that someone's solving that problem now. Transportation in the case of flying cars, right? And so before Uber, you could use taxi cabs. Before Airbnbs, you could use the hospitality industry. And so there's a way that people are solving the problem now, and then you just kind of have to be creative about how you think about measuring that.
Could each of you talk about, just share an example of a red flag that showed you a founder didn't fully understand the market they were hoping to enter? Helen?
We did pass on a company. The company that comes to mind is one that we passed on because we actually felt like the TAM was a little bit small. And so, is there too small? I said, yeah, sometimes, maybe there can be, and even for a small fund like ours. And I think it's mostly because even if you start out with a small TAM, and you have a big vision, you can really see how this really useful solution, product will be able to extend itself into other sectors, right? And that's going to become increasingly important as the company matures and seeks, additional rounds of funding and broadens their audience and things like that. But I think even if from the beginning, you feel like where they can go with that sort of specific product is pretty limited, I think that is a limitation. And I say this is definitely the smallest fund on stage.
You're doing checks in the 100K to 500K size, or?
250K, yeah.
Okay. Yeah.
Yeah, so I don't want to be too specific because this company...
Spill the tea.
They do something very unique. But I think, one thing that I've seen occasionally is a founder not understanding how the market has changed or shifted, right? So the founder has a product. People are actually doing this, executing this on other platforms, but they're creating a platform specifically to sell this type of thing. But that thing has now changed in the wake of COVID-19, right? Because user behavior has shifted. And the founder has not shifted their assumptions, their hypotheses to now meet the new reality that we find ourselves in. And I think that's really challenging because sometimes you fall in love with the solution or the product, but what you should actually be falling in love with is the problem. Yeah. And so the best founders are able to shift and morph and modify based on new information And when I see an inability to shift and modify, or really being in love with that product so much so that they don't want to change course, that's somewhat, it's a reddish flag.
I feel like such a great example of this is the Instacart IPO, where there were a lot of folks the last couple of years saying, questioning whether Instacart could continue their momentum and their growth, and is the market as big as we thought it was during COVID? And, they have made some strategic pivots to really, increase their TAM in sort of in interesting ways and build out different parts of the business to really, sort of meet that expectation. And a lot of people thought that they couldn't do it. So I think that's a good example of just sort of adjusting as
Exactly,
they go.
the delivery of just groceries to,
Right.
and like very Whole Foods embedded to now the delivery of everything.
Yeah,
I mean, you can
exactly.
get Sephora on Instacart.
Jomayra.
I think the biggest red flags, honestly, I won't use a specific example, but it's more so related to, as you start questioning the assumptions that they're making, do they fully understand, as Monique was saying, the way the market has changed? Do they fully understand how people are solving this problem today? My biggest pet peeve is when someone says, we have no competitors. And I'm like, you do. You always have a competitor. There is a way someone is solving this problem today. And so almost being hand-wavy about some of the unique dynamics of their market, I think is one of the biggest red flags that I notice.
I mean, but are you willing to accept jazz hands and other parts of their deck, but you wouldn't in the TAM? Where's it okay to make a mistake? I suppose like this. Is a TAM mistake more critical than a team mistake or a problem mistake? Or I'm not sure if I'm asking the question correctly, but how badly can you mess up your TAM slide and still save the meeting with an investor? That's the question I'm asking.
I think I don't know is always an okay answer, as long as you're then willing to, let's go through the exercise of getting to a knowable point, right? I would rather have an I don't know than pure jazz hands.
Agreed. I totally agree. Because we're also testing for just learnability and coachability and adaptability, because that's going to actually be the most important trait for early stage founders. And so being willing to say, I don't know, but then being willing to actually do the work in coordination with the investor, I think shows a lot more than the jazz hands. And the other thing is, the best founders are not going to be great investment analysts or finance folks, right? And so I don't expect you to produce this amazing TAM analysis or this amazing financial model that, shows you have everything put together. I'd rather you be an amazing product person, a great person at hiring people. Those are the things I need you to be really good at. But then for the TAM piece and the financial model and all of those pieces, I just need you to be willing to learn and be open to having that conversation. And so there is no necessarily, I guess there are some mistakes on the TAM slide that you can make, but I wouldn't treat those as, oh, I'm no longer interested in this having this conversation, or it not being a non-starter.
Some of the best conversations or interactions that I've had with founders have been after, we go through a meeting, maybe we have some sort of back and forth about a certain aspect of the business that we don't agree on, right? And then they come back and say, hey, with an email and very detailed answer about how they think about it. Or, they've gone back and thought through things and said, maybe I didn't express that in the way that I wanted to. Here's an update for you. Mm-hmm. Those can be really good interactions, and I think those are helpful for investors to understand how you think about things and understand how you might interact with us in a real life situation.
Yeah, it's the conversation that you mentioned going back and forth. And so I don't think it's always going to be the investor evaluating whether the founder is coachable or teachable. It's also how much am I learning from that founder? Because they've got insights into a corner of a market, a small one maybe at the time, that are going to help me become a better investor. And I think also the best way to sort of differentiate yourself and make yourself memorable is if you actually leave them with something that that they've learned that day, right?
So if you believe in, if it seems like a good team, then you're willing to coach them through how to be better with TAM, it sounds like. Good. Monique, your fund is really very thesis driven around demographic change, as you said. A a lot of investors don't seem interested in backing companies that cater to these demographics. And without being like jejune, I don't really understand it because women are, 50.4% of the population. That seems like a pretty decent sized total addressable market. Why aren't there more funds like Cake Ventures?
The flippant answer is because they're not as good as me, but let me not give you that answer and give you like some nuance. I think, I invested in my first aging-related startup in 2016, right? And now we're starting to see a lot more people interested in longevity, interested in our aging population, realizing that we have a care crisis. We don't have enough caregivers for the amount of people who are going to age into needing care. I still think people are slow to recognizing the power of the female dollar, but as companies like Skims is $1 billion company, Fenty is $1 billion company, Modern Fertility, Kind Body, as we see more of these $1 billion plus outcomes, a company like Fair, it's like a $4 billion company, Teladoc, telehealth company. Women are the biggest consumers of telehealth, and I write insights reports and white papers to show people, especially other investors, that this isn't just, it could be easily earmarked as diversity, but this is actually about markets and about market building and the things that are, the changes to the internet user base that are going to affect many different aspects of technology. I think sometimes people get comfortable and siloed within what they already know, and it takes them, even investors who are supposed to be, risk-taking, it takes them a really long time to change their mental models around certain markets. I think I have been able to come in with a fresh perspective around things like aging and longevity or the increased spending power of women or other demographic shifts that are happening. And I am slowly starting to see other people be really interested in those things as well.
That's good. Glad to hear it. I wanted to talk about also just going back to the whole preparation thing, common mistakes with TAM. Jomayra, I think in our prep session, you mentioned like one of the things people will quote research reports kind of lack nuance. Are there other things you see people doing that you wish they would just stop doing when it comes to presenting a TAM calculation?
I think, going back to that specific example, it's definitely kind of, hey, here's the big, large number, and then the overall pet peeve I have in general is just not going into the drivers, like really going into the details of, hey, these are the ways this demographic is changing. This is the way the behavior is changing. These are the ways that our competitors are changing. Actually going into the details is where I see really, or the lack thereof is where I see the mistake. I often see, hey, here's the big number. Here is the link to the research report that said this big number. And it doesn't account for a lot of nuance. So even a specific example, we invest, again, in education, and I often see people use this large, here is the learning and development budget dollars that are spent across the US, and so this is our TAM. And they don't realize that like 70% of that is headcount. And like a smaller percentage of that is actually software. Now you can make the argument that those things are changing. You can make the argument that that you can capture more of those dollars, but oftentimes they just use this big like $70+ billion market as opposed to actually looking at the nuance under it.
So Helen, question for you. Most first-time founders, they don't have that experience. This is the first time they've ever tried to analyze a market. So in doing the process, putting the process aside, for a first-timer, who would you recommend they run it past before they put these out in the world as far as showing it to an investor? Like if I was just coming up with a TAM for plant-based dog treats, who should I show it to before I show it to you to make sure I've got my numbers directionally correct?
I would talk to other people who, you think are in that sector of that, I think of it as like layers of an onion or concentric circles. And, in the beginning, you start right from the middle and it's the smallest. And it's probably going to be probably going to be like a community that the founder themselves is very familiar with. I think every large company large successful company we can think of, the founding story is typically it's the founder and a problem that they were trying to solve and a market that they knew because they were the market, right? And so I think that validating that with, people around them, I think that's totally fine. They don't have to grab somebody elsewhere for the overall sort of, how large is this market? You tend to know like how large your community is based on sort of the channels that you spend time with or the different groups, things like that. I think not to answer, the question that you asked Monique, but it's like one reason why we're seeing, a lot of the same types of companies get backed, right, is because we're not really looking at the companies that are building like massive companies where the target market is really everyone, and we're really not dissecting kind of how they get from each of those layers of the onion, from start to finish. And one way to really reach into more pockets of your TAM is to have a diverse set of investors, a diverse set of founding members of the team, a diverse set of early customers and things like that. Because I think otherwise, you might hit that limit of like that concentric circle and never really be able to break out.
I mean, would it be fair to say that it's kind of like a Rorschach test of sorts, or like a personality screener, as far as like you get the TAM slide and you're kind of you get a read of where this person's coming from and what they're capable of? Is that fair?
We definitely assess whether this team is going to be able to either connect with the next set of 2, 3, 4 layers of that audience, whether it's through channels that they've built before, communities that they know how to plug into. Are they great at hiring and they're going to bring in people with great experience, who have done that before? And so, yeah, I think definitely there are so many examples. I think in the last 5 years or so of like YC companies that are amazing, and their like addressable market is like other YC companies, and those are actually fantastic businesses. There are so many great examples of companies like that, but I think that the bigger question is like what happens after they've got penetration of 100% of YC companies. I mean, you could say the class sizes keep growing every year, but like, I think that's where we really pay attention of how do you break out of sort of your own circle.
We've got about 9 minutes left. I'd like to see if we have any questions from the audience on this topic. Sorry. I don't think we... Oh,
We've
one
got
person.
one over
Yes,
here.
please. I'll give you a chance to get to the mic. Thanks. We cannot hear you, but if you can speak up a little bit. I'll repeat your question for the room.
Okay, thank you.
Oh,
here
you're
it is.
on.
All right. It was great hearing about all the like red flags and pet peeves and things like that. I was curious if there were any more examples of something you've experienced when you look at somebody's deck and you're like, oh, this gets me excited to ask more questions. Something that's maybe on the TAM slide, or if it's on an adjacent slide, it could be anything else as well.
Most of the things that we identify are truly not pet peeves and red flags, to be honest. I really like it when founders teach me something about a potential investment. If they can teach me something about the consumer or a difference in behavior that is new. I think we're all looking to be taught something by founders that we want to invest in, and so you can use many different parts of your slide your deck in order to do that. It's not just the TAM slide.
I totally agree. Just to double down on what Monique said, earlier this year, one of the decks that I received had this really interesting stat on a change in consumer behavior, particularly with Gen Z, that I hadn't realized. And to be honest, I don't think I would have had I not run into this company. And that alone made me say, hey, I want to actually meet with these founders. At the very least, I'm going to learn a lot more about this demographic. And also, I was interested in the company. We ended up investing for what it's worth. But being able to see new information that I wasn't even aware of is super interesting.
Thank you so much.
Yeah, I think there's sources, right, that we mentioned, like reports and things like that. There are, and then there's also, so insights and things that you've learned, sort of early days. And then there are assumptions. And I think assumptions are some of the areas that we've had the richest conversations about, why is that your assumption, right? And then if we have a different one, I think that's a really great starter of a conversation to really get to understand, how you look at the world. So I wouldn't be afraid to even have those in there.
Thank you.
Yes, over here.
Thanks so much. I wonder if you could drill down a little bit for me between TAM, SAM, and SOM, and if you're seeing AI now change the calcs on what the service or what the SOM is, and really where we can, generate a revenue prediction.
I mean, none of you are AI first investors, so I'm not sure if you can answer.
I mean, I guess just to sharpen that, right, is the implementation of AI for us as startups, right, allowing us to reach a larger percentage of the TAM. And do you guys take that into account, or do you think that's a valid argument?
So are you asking when startups use AI within their businesses, like they're not an AI business, but they're using AI to execute something within the product, does that impact the addressable market? I think it often allows the company, the startup, to do something faster or with fewer people. And that's not necessarily a direct impact on TAM or on SAM or SOM, but it makes for much more efficient companies, right? And so it makes it much cheaper, faster, may make it much cheaper, faster, easier to build that company and to scale really quickly using the technology, using the AI, even if it's not an AI company.
Are you seeing that in pitches now? Are people starting to mention that?
I think they're not necessarily making that argument in the pitches that I am seeing, but they are using AI within the product in really interesting ways. A company that I committed to just earlier this week is actually using AI in a really interesting way, even though they are not an AI company. And that is allowing them to build something that other platforms of the same type have not been able to build, right? And that was very exciting.
I look at developer tools companies a lot, and that's maybe one example of like an assumption that the founder made, and actually with AI they're seeing more people be able to start technical companies because the development time and sort of the learning curve to be able to get like a prototype is actually reduced with AI. And so if there are more founders who are able to get to a working prototype quickly, then maybe we're increasing the TAM of sort of like the number of people who might use something that developer tools. Yeah, so that is something, probably one example of that I've seen.
Did you want to weigh in? Or?
No.
Okay, great. I think we have another question over here, please.
Hi, my name is Alicia Contreras. I work for the Center for Accessible Technology, and we want to be sure that all technology is accessible for people with disabilities. We hear a lot about diversity, and as my new friend Paul was saying, it's so cool to see so many women here, and women of color, and men of color, which is not something we would see before. When it comes to disability, we're still really behind. And when you are investing in companies, I mean, let's say that you invested in Lyft or Uber, for example, there are rules taxi companies have been, have to fulfill. Like, they have to have taxis that are accessible. We see Uber and Lyft, big battles, and now there is Waymo and all these new companies that are just keeping all the rules. And that means that if I want to get just a vehicle just like everybody else, I can't. And all these things are barriers that are, just being put there. I'm wondering, like, and Monique mentioned, like, you are talking about, you are seeing that there is also like the elders market, and there's the, people with disabilities is another market. So I'm curious, like, do you give extra points to those founders that come to you with a plan to be really inclusive and are thinking about diversity? Is that something that is actually in the conversation when you are talking between investors, or when you are recommending? Like, do people get extra points?
Thanks for your question.
Or what can you do to be sure that disabilities is not, farther behind? Thank you.
Thank you.
It's an excellent question, and I'm going to cheat a little bit because at least for us, because of the sector that we're investing in, you actually can't afford to not serve certain subgroups of the population. So we invest in education. if you look at the population of students that exist in this country, increasingly we're seeing students with disabilities, with identified disabilities, increase in English language learners. We are now a majority minority country. You actually can't afford to not focus on diversity and build a large business. And so for us, like, we do take actually quite a bit of time to think about, hey, if you're putting tools in front of students, like, how do you think about accessibility to make sure they can actually use it and leverage it and get value out of it? So it is something that we think about very deeply because it's just in the nature of our work.
I think we have time for one more quick question, I'm sorry. And then there also will be another Q&A session in the TC Plus Lounge. But if anyone has a short question, I guess over here, yes?
I have a short one. Thanks, y'all, for coming. I have a question about, you mentioned earlier, founders oftentimes coming from the markets that they're representing. But what about a case when your founders are good at the technology that they're creating, but not so much at the industry that they're representing? What do you like to see with those types of founders?
I think I like to see an acknowledgement that they don't know everything, right? I love technical founders, technical CEOs. Sometimes those founders or those CEOs are not as good at the business development or the selling, and knowing that they can build a team around them to support them in the areas where they are less experienced, that's a big green flag for me.
Yeah, just to build on that, I would say just work on your story and selling your vision. If you're one-on-one able to convince me that this is a really exciting category to get excited about, then I'm going to be able to imagine you bringing on board, a really great partner or early hire to really help you with that side. Or, I think in the beginning, the CEO, founder-led sales is real. And so if you can't convince me one-on-one, I'm going to have a more difficult time seeing how you're going to convince your early team or your early customers to sort of follow your vision. So I think that's something that anyone can work on. And even if you're not, you don't self-identify as like an extrovert, one-on-one, I think everyone can really inspire, and share your vision.
Yeah, I would plus one what's already been said, and I would say, you could also, even if you don't have the funds to bring on team members that have those skill sets, you can find advisors. You can find folks that will be able to actually look at your product, give you advice, give you feedback. So it's always possible to actually complement your technical knowledge with some industry expertise, and not maybe in some cases not necessarily have to pay for it before you raise capital.
Thanks again for great questions. Thank you for a fantastic conversation. We'll see you in the TC Plus Lounge afterwards. Thanks, everyone.
Thank you.